All right, so you're looking to make those small savings work harder, even if you're starting with just a few dollars here and there. Well, that's fantastic. Today, we're going to dive deep into exactly that, and we'll be using mymoney.gov and the SEC's guide, Saving and Investing, a roadmap to your financial security.
Both are incredible resources.
Yeah, totally packed with advice.
We'll pull out the most actionable strategies from these resources so you can set yourself up for success, even with small savings.
Think of it like we're building a financial rocket ship, one small, powerful booster at a time. We'll uncover some surprising insights along the way about how much those small savings can really add up.
I love that analogy. And speaking of building, both sources really emphasize that strong foundation, that importance of a strong foundation. Think of it like constructing a house. You wouldn't start with the roof, right?
Definitely not. Makes sense. So what's step one in creating that financial foundation?
MyMoney.gov highlights forming a savings habit, that pay yourself first mentality, and using automation, the power of automation.
Okay, so before I even think about that impulse purchase, I'm setting aside a chunk of money specifically for savings.
Exactly. And the SEC guide adds another layer with the net worth statement exercise. It's like taking a financial inventory.
Oh, interesting.
You list everything you own, your assets, and everything you owe, your liabilities.
So it's a way to see exactly where you stand financially right now.
Exactly. And it's crucial to know your starting point for any journey, especially a financial one, right? And this ties back to pay yourself first. When you create a budget, include your savings goal as a fixed expense in your budget.
Hmm. That's really smart. It's like tricking yourself into saving, almost. You just automatically assume that money's gone before you can even think about spending it on something else.
That's the power of making it a habit. The SEC guide uses a really brilliant example. Just saving the cost of a daily cup of coffee, let's say $5, could add up to over $7,500 in 30 years.
Wow, that's incredible. But how is that even possible? How is that even possible with such a small amount?
That's the beauty of compounding. It's the snowball effect of finance. Basically, you earn interest not just on your initial savings, but also on the interest that money generates over time.
Oh, so even if you're only saving a little bit each day, those small amounts are working hard for you in the background, multiplying over the years.
That's right. It's all about letting time and consistency work their magic.
Okay, I'm starting to see how these small savings can really add up. But both sources are pretty adamant about tackling high-interest debt before even thinking about getting serious about investing. Why is that?
High interest debt like credit cards can really eat into your investment gains. It's important to manage that debt strategically.
So even if I'm consistently saving and investing, if I have a ton of high-interest debt, it's kind of like taking one step forward and two steps back.
Exactly. The SEC guide has some practical tips for getting that debt under control. Put away the plastic, understand how much you owe, focus on paying down those high interest cards first.
Solid advice. And they also suggest seeking advice from a qualified financial advisor for a more personalized approach.
Absolutely. A professional can help you create a debt management plan that aligns with your specific situation. So remember, the foundation is about saving consistently and strategically managing that debt.
Okay, so now we've got that solid foundation. We're saving regularly, and we're tackling those debts. But how does our money actually start working for us? Where does investing come in?
That's where things get interesting. The SEC guide breaks it down into two main ways your money can work for you. First, it can earn interest or dividends. Think of it as your money receiving a regular paycheck.
So just like WE get paid for working, our money can get paid for, well, just existing.
Exactly. And the second way is by increasing in value through ownership. It's like buying a piece of a company or a piece of something and potentially seeing that value grow over time.
Okay, I like that. So it's almost like having our money wear two different hats. One is like a steady worker, bringing in that consistent income, and the other is like an entrepreneur, taking on some calculated risks for potentially bigger rewards.
I love that analogy. You got it. And the NCC guide emphasizes that your investment choices should always be tailored to your time frame and risk tolerance.
Hmm. Yeah, it's not a one-size-fits-all approach. So what if I'm saving for a shorter-term goal?
For short-term goals like a down payment on a house or a vacation, safer options like savings accounts and CDs are often better because they offer lower returns, but your money is more easily accessible.
Got it. Lower risk, Lower potential return. What about those longer-term goals, like retirement?
For long-term goals, you have more time to ride out those ups and downs of the market so you can handle more risk. That opens the door to potentially greater growth through investments like stocks or mutual funds.
So it's all about finding that balance between risk and potential reward based on your goals and how long you have until you need the money.
Exactly. And now that we've kind of laid the groundwork, let's explore some of those investment options, how your money can actually start working for you through those investments. The SEC guide breaks down these fundamental investment options.
Okay, so let's get into it. Stocks and bonds. I know they're important, but honestly, they've always seemed a bit intimidating.
I understand, but they're really not that complicated once you break them down. Think of stocks like owning a slice of a pie, where the pie represents a company. If the company does well, your slice gets bigger and more valuable.
So it's like taking a chance on a company's success, right? And what about bonds?
Bonds are more like lending money to a company or the government, and they promise to pay you back your original investment plus interest over a set period of time.
So bonds are generally considered safer than stocks, but they typically have lower potential returns.
Exactly. And the SEC guide is quick to remind us that with any investment, there are risks. There are no guarantees of returns, and you could even lose money.
Yeah, that's a really good point. It's really important to remember that investing always involves some level of risk.
Absolutely. Which is why diversification is so important. Don't put all your eggs in one basket. Spread your investments across different asset classes like stocks, bonds, real estate to reduce the impact of any single investment on your overall portfolio.
Right, so spreading things out helps manage the risk a little bit better. Now, the SEC guide also talks about mutual funds and EPFs, which seem like they might be a good option for beginners. What can you tell us about those?
Mutual funds and ETFs are essentially baskets of stocks, bonds, or other assets. They pool money from multiple investors to invest in a diversified portfolio, which can be a great way to get instant diversification even with a smaller investment.
So instead of trying to pick individual stocks or bonds yourself,
Mhm.
you're kind of handing over the reins to a professional fund manager who makes those decisions.
Exactly. And these fund managers are aiming to achieve specific investment goals like growth, income, or a combination of both.
Hmm, that sounds pretty convenient. The SEC guide even mentions index funds as a low-cost option that tracks a specific market index. What is an index fund exactly?
An index fund is designed to mirror the performance of a particular market index, like the S&P 500, which represents the 500 largest publicly traded companies in the US.
So with an index fund, you're essentially betting on the overall performance of the market rather than trying to beat it by picking individual stocks.
You got it. And index funds are known for their low fees and simplicity, which makes them a popular choice for a lot of investors, especially beginners.
This is all fantastic information. I'm feeling much more confident about these investment options now. But before we get too carried away with picking investments, both mymoney.gov and the SEC guide really emphasize the importance of protecting yourself and seeking help when needed.
Absolutely. MyMoney.gov reminds us to check the credentials of any financial advisor before handing over your hard-earned money. Make sure they're legitimate and qualified to give you sound advice.
Right. And the SEC guide offers some helpful tips for choosing and working with an investment professional. What are some of those key things to look for?
Definitely ask about their experience, their investment philosophy, and how they get paid. Transparency is key. Don't be afraid to ask lots of questions. You want to make sure their recommendations align with your goals and your risk tolerance.
Right. It's your money, your future. You need to be comfortable with the decisions being made.
Absolutely. And one more crucial point, get everything in writing. A paper trail is always helpful to make sure everyone is on the same page.
Excellent advice. We've covered a lot of ground in this first part of our deep dive, from building that solid foundation to exploring some key investment options. I'm feeling much more empowered to make those small savings work harder for me, but I know we have a lot more to cover, right?
We sure do. In the next part, we'll tackle a listener question about making those small savings a reality.
Sounds great. We'll be right back after a quick break.
Sounds good.